Hey everyone, me Kevin here. In this video, you're going to take away two things. Number one, you're going to find out how much research suggests the market could continue to fall. And the second thing is you're going to take away exactly what the Federal Reserve is going to be looking at in their meeting that starts today and ends tomorrow and culminates with the Federal Reserve telling us exactly what they're going to do at 11 a.m. Pacific time tomorrow. So stay tuned. I'll be live streaming that. It's going to be huge tomorrow for the markets. Okay, the very first thing though, before we get into this, is I just have to say two things. One, this video is brought to you by Titan, link down below, but also Andre, how could you do this to me? Andre's one of my buddies, one of the homies. And a lot of you on the channel know that I put this together. I thought about it, I edited it, I put it all together, and I did it for free. I put together a video on the Titanic, right? You remember how the Titanic is kind of like the analogy of the market or the allegory of the market? That video got like 300,000 views, but I got nothing for it. And that's okay. That's okay. I made the video expecting not to get anything from it because copyright claimed it's ineligible, right? But my boy Andre, come on, dog, come on. Made a video, got over 200,000 views, talking about what happens next in the super bubble, and uses my entire Titanic clip without even as much of a, hey, good video clip. Kevin, now I still like you, Andre, but come on, man. Come on, man. That is not cool. That's all I gotta say. I didn't even make a whole video using the Titanic clip. Maybe I should have. Dang it. All right, let's talk about the Fed. It's more important. We gotta talk about the Fed. All right, first, I said you'd get two things out of this video. Number one, how much pain? Let's talk about that, and then the Fed. Okay, so according to research, when the NASDAQ drops more than 4% in a day, which only has happened in the dot-com bubble and during the Great Recession, and then reverses to a positive, that sort of big drawdown and quick reversal happens in bear markets. It's very, very bad. I mean, it doesn't necessarily mean it will always happen in bear markets, but it's kind of a bad signal for markets, right? And I made a short on this. You probably saw it yesterday. Maybe you didn't. But anyway, that is a statistic that came out yesterday. And the research that went along with this was really interesting. When I dove deep into it, the research suggests that when we see the NASDAQ 100 go minus 4% to positive in one day, the median NASDAQ return over the next month, or I should say, how much is the NASDAQ worth 1 month later? The NASDAQ tends to be worth 5.5% less 1 month later. That's the median term. So that would be February 24th. The market might be worth about 5.5% less. The 3-month median, so a longer term mindset, right? Longer term. I mean, look, years I'm bullish on this market. Short term, I'm quite bearish. Anyway, I think that's obvious by now. But anyway, 3-month decline, the median expectation is a 7.9% decline after this sort of correction and reversal. It's kind of bearish. Now, I want to be very, very crystal clear because there's a lot of misinformation. I'm only 0.6% short in the market, Lucid and Arcade, that's it. 0.6%, it's $120,000 in my portfolio. 9% long, it's about 1.8 mil, and the rest is cash. That's it, okay? So, you know, sometimes people are like, oh, Kevin's just 100% shorts. This is not true. But I do send every single stock purchase and sale that I make in the Stocks and Psychology of Money group, link down below. Okay, now, we got to talk about the Federal Reserve because this is a big deal. So, to understand the Federal Reserve, we've got to do two things. One, we've got to look at the data that we've recently gotten, and then we have to compare that to what the Federal Reserve said in December. Because what we're looking for is if the Federal Reserve was disappointed in December, then maybe they've gotten happier and they're going to be dovish tomorrow. They're going to U-turn and the markets will be all rosy again, right? Maybe. I hope so, because I want the pain to end. I want to buy back in once I have the catalyst that says the pain's going to be over and we go to the moon. That's what I would love. That's what I want because I want to make money. And since I'm mostly cash and not long short, I don't benefit from the market going down. Okay, so here's the latest information that we know, and then we're going to talk about the Fed. So the latest thing that we know is that banks expect slowing customer deposits for 2022. All of the banks basically said this in their earnings calls. I read the earnings calls. They also recognize that the savings rate has fallen, which is not good because that lowers the amount of cash people have available. We had a survey, and when I say survey, it's more like a study from the Federal Reserve. This matters. The New York Fed came out and said, look, people are spending more money on essentials and less money on non-essentials and plan to spend less money on non-essentials. That's not good. That's slowing consumer growth, right? The Netflix massive forecast reduction is probably going to be considered a COVID-related drawdown, so I'm not going to focus so much on Netflix. But in my opinion, the real issue is actually in earnings that we got today, and it's a really big issue. Listen to this. General Electric is, quote, grappling with worsening supply chain pressures and the effects of the Omicron variant, leading the stock to fall 6 to 7% in trading today. They're dealing with supply chain issues across all businesses and issues that are becoming, quote, persistent. That's a bad word. Persistent supply chain issues, which is similar to persistent inflation, right? And they can't get orders out of the door due to component shortages and many other issues. Yet at the same time, margins are expanding. So the company's making more profit. So it's not like the company's suffering or somehow unable to hire folks if folks were available to be hired. But they're having so many supply chain issues that are getting worse because of Omicron. Now, this is going to be a big deal when we talk about what the Fed has to deal with in just a moment. But first, I have to send you to a message from our sponsor, Titan, which I'm really excited about. Thank you, today's sponsor, Titan. It takes a lot of time to keep up with everything going on in the stock market. I know, I spend hours every single day researching everything that goes on. And quite frankly, this is where Titan can help you. Titan is the first investment platform for everyday investors that want their money actively managed by a team of experts. They do the research for you, so you don't have to spend hours or reading articles and understanding the Federal Reserve reports or stressing out about the minutes. Oh my gosh, the minutes. Having someone else manage your portfolio can save a lot of time and a lot of stress, and you can get started for as little as $100. They even offer an actively managed crypto portfolio, so even if you're not a complete expert in crypto, but you want exposure to crypto, they can take care of you. The Titan team can manage it for you. You'll even see exactly how your money is managed through their video, audio, and written updates through their proprietary mobile app. Right now, if you use my URL, titan.com/Kevin, you'll get your first 3 months of investment management totally for free, 0 fees. And you can now join the smarter way to invest with Titan. And all it takes is clicking that link down below or going to titan.com/Kevin and $100, and you can get started. Remember, that's titan.com/Kevin for 0 fees. Now let's talk about 3M. So 3M says they are so confused with what's happening with Omicron and supply chain issues that they are actually delaying providing any forecasts until February. Wild. In addition to that, Raytheon, all 3 of these companies reported today. So this is fresh information I reported this morning. Raytheon, guided lower into 2022, does not believe that inflation pressures will ease until, quote, late 2022, and took a $150 million expense in, quote, unexpected inflation-related cost increases. Labor shortages are also hitting supply chains, they say, and the supply issues will end up hurting deliveries for their company. However, demand is not slowing, even despite Omicron at Raytheon. So that's actually kind of like a worst case scenario where it's like demand is still strong from the Fed's point of view, right? Demand is still strong, but they're having these labor and supply chain issues that are making things worse. Not great. Okay, all right. So these are from 3 companies that reported today, all 3 of them in the industrial space, which is where manufacturing is very, very important. This is different from like a Snowflake reporting. They're selling software, or IBM, who's now saying they're 70% software or whatever. The IBM earnings were like a nothing burger. They were so confusing with their guidance, and I'm not the only one who's confused. Even the analysts were like, this is weird, y'all weird. Anyway, okay. Now let's understand the Federal Reserve, because this is a big deal here. So the Federal Reserve, in the last notes from their last meeting, said that rates are their top priority as a policy tool. Jerome himself said that Federal Reserve policy action with rates can act quicker to slow the market. And we know that if we if we reduce the balance sheet, there's so much money left in the system, especially if you look at the reverse repo market, that basically there's so much cash available that it doesn't really matter if they take some of the cash or they start vacuuming up cash from the markets. We're not going to feel that effect until like later in 2023. The more immediate thing that's going to slow this market down a little bit, which is kind of what the Fed believes we need, is rate hikes. But that's also what the stock market is afraid of, is rate hikes. So Jerome Powell says rates are a top priority, and that we are better positioned for policy normalization than we have been in the past. So in other words, rates are our top priority, and we're more prepared now than ever to hike rates. Now, they don't actually expect to complete their taper until mid-March. They said this in December. So it would be a rug pull from the Fed if they ended their taper or sort of their bond buying program. If they ended that, they completed their taper early in January. That would be a surprise. That would mean the taper ended 2 months earlier than expected. That would be a rug pull. I would expect markets to freak out tomorrow. However, the market might be going as extreme as thinking that the Fed's going to raise rates tomorrow, which I really don't think is going to happen. The Fed has said they will not raise rates until they finish the taper. So the expectation is they're just going to say tomorrow, hey, look, we're going to complete the taper by March, then we're going to raise rates, which kind of means they're kicking the can down the road, and all those fears are getting kicked down the road a little bit, which is not great. Okay, then the Federal Reserve said that one of their big goals, and this is very important, one of their big goals is to limit yield curve flattening by potentially running off the balance sheet versus just using rates. So I looked at what the yield curve is doing and what it has been doing since their December policy meeting. And since their December policy meeting, the yield curve has actually not flattened any further. So the yield curve flattening has stabilized. So understand this for a moment. If the Fed is worried about this line over here going down, and maybe they won't raise rates if this line goes down too fast, then it would be a problem. If this line were going down fast, it might actually be good news because the Fed might say, oh, that line's going down too fast. That's a problem. Let's not hike rates. But it's not going down. And if the Fed is saying they want to limit yield curve flattening and might, not be so aggressive on rates if the yield curve keeps plummeting, then the reverse would be true. That if the yield curve stays stable, they could actually be set up to raise rates. So look at the nastiness that we're setting up for here. We're setting up for a big nothing burger tomorrow, kicking the can down the road to March, where in March we hike rates, and the Fed says, see, yield curve stable, time to hike. Maybe we even need to hike a little bit more than we previously expected. That fear is going to eat away at this market. It's going to be a slow bleed. Now, the Federal Reserve is also calling for modestly lower growth over time, but as they start raising the federal funds rates, but they're okay with that. So they're okay with slowing the economy to raise rates. And the way I look at this is by looking at their dual mandate, maximum employment and stable prices. Well, they're failing at stable prices, right? So their success is like failure. Inflation is a failure. Whereas on jobs, they've succeeded substantially. Well, so what they need to do is they need to fight inflation. So they need to bring up their efforts against inflation. Now, when they bring up their efforts against inflation, they might actually bring down how crazy this job market is and businesses' desires to keep hiring and paying more for people because there's so many job openings, but not enough people to actually take the jobs right now that it doesn't really matter. You get so much meat on the bone, so to speak, on the job side that even if we fight inflation, we can cool down the amount of hiring a little bit and not really affect the economy. So the Fed has this really big buffer right here, whereas they're failing on the inflation side. So in other words, when people say, oh, no, the Fed's not going to want to crash the economy because that's going to hurt jobs, we have so much meat on the bone in terms of the job market. That is, there's so many job openings. We could literally have 50% less job openings and still have a tight labor market. Like the markets, people would still be able to get a job and still have wage increases. Like that's not a problem right now. So the biggest problem is inflation. And so wait a minute, if you start putting these things together, their priority is interest rates. As long as the yield curve is stable, raise rates. We can raise rates without devastating jobs. We don't mind if we have slower growth. We also don't mind if valuations in the stock market come down because we believe that high valuations lead to excessive risk-taking, excessive debt-taking, excessive speculation, and that actually creates more of a risk to the financial system. So when you start putting this puzzle piece together here, you're like, oh my gosh, the Fed is gonna, in my opinion, and I imagine that you might think the same way, there's no way the Fed's not gonna want to raise rates aggressively. Again, raising rates is substantiated by the yield curve not falling more, not flattening more, the inflation problems we're having, the persistent problems we're having with the supply chain issues. If we take some demand away, we could finally give supply chains a little bit of time to grow, right? Or to like breathe a little bit. Doesn't matter if valuations come down because that actually helps the Fed's mission. Doesn't matter if job openings constrict a little bit because we've got more than we need. So all of a sudden, when you put all this together, it's like they're going to hike rates a lot. And this is going to be a painful year. At the same time, business, mortgage, card, and auto loan defaults are at record lows. There's more upside risk that inflation is going to continue running. And put all together, I think what's crystal clear about what's going to happen here as a bottom line is the Federal Reserve is going to finish their taper probably by March. If they finish the taper early, the market's going to tank. If they come out tomorrow and say, hey, we decided to finish the taper early, we got big problems in the market. That's going to be a big issue. To all the people who think the Federal Reserve is going to bail out the stock market tomorrow because the NASDAQ and the S&P farted 8 to 12%, dream on. I like really dream on. I hope I'm wrong because, again, I want to be in a bull market. I want to throw all my money back in and I want to ride the rocket ship, okay? But I think it's totally wrong because if you go back to those minute meeting notes from December, you could see where their head is. They are worried. Let's draw a little summary box here, okay? They're worried about supply chain constraints causing inflation. They're worried about broadening inflation. What did the IMF say today? Inflation is broadening. They're worried about consumers spending more on essentials. We just got that report yesterday from the Fed, from the NY Fed, right? Literally, the Fed is reporting that. On top of that, they don't care if prices come down in the stock market. It's a good thing. Next, they don't mind if jolts or slash job openings, we'll say, job openings decline because we have plenty. Because we have plenty. We won't hurt the job market. And then as long as the yield curve does not flatten more, rates are the preference. I don't understand how much more clear the Fed could be. Like if I were like J Powell and people are like, oh, J Powell, you're going to bail us out tomorrow, right? I'd be like, have you literally not paid attention to anything I've been saying? We are desperately concerned with supply chain constraints being persistent and causing more inflation and broadening inflation, which we got from the IMF today. And we're hearing from earnings reports today. I mean, like the latest information is that things are getting worse, not better, and they're probably going to be bad through the end of 2022. Consumers are spending more on essentials, which means more inflation, right? Energy costs, food, so on and so forth. We don't really care if valuations go down because that reduces risk in the market. We don't mind if job openings decline because we have plenty of job openings. And as long as the yield curve does not flatten more, rates are the preference. Literally 1, 2, 3, 4, 5, 6. All 6 of these reasons right here say Fed, hike rates, hike rates, hike rates, hike rates, and 6 times over, right? That is going to set us up, in addition to that price decline information that I mentioned earlier, for probably either a slow bleed market over the next 3 to 6 months or a lot of volatility. So don't be surprised to see your portfolio swing in crazy ways. Now, bottom line, I don't recommend you just panic sell. Don't panic sell. I did not panic sell. I'm making a very strategic bet on Jerome Powell. But don't look, I study Jerome Powell, I believe, more than anybody in the world. Okay, maybe there's some economists who study him more than me. But I believe, that, I mean, this guy comes up in my dreams and my nightmares, okay, in both. He's like the most recurring character of my dreams. It's crazy, and nightmares. And it's really, really annoying. But anyway, look, the bottom line is, I'm bearish in the short term, bullish in the long term. For most passive investors, you're better off just buying the dip and dollar cost averaging. For active investors who want to make a bet, hey, here's something to consider. But what you should also consider is using that coupon code linked down below before my birthday, before that expires, and of course checking out Titan via the link down below. Thanks so much. Bye.